Hello, and welcome to our Growth, Selling, or Succession How Firms Are Choosing Their Next Move webinar. I'm your host today, Matt Staninger, Market Research Analyst at Oak Street Funding, and joining me today is Bob Lewis, President of the Visionary Group, and Doug Lewis, Managing Director at the Visionary Group. Today, we will be breaking down how CPA firms are navigating the choice between growth, selling, or succession. We will also cover key industry trends, how they're shaping M&A decisions, and more. If you have any questions throughout our presentation, please submit through the Q&A feature, and we'll get to as many as time allows. If we do not get to your question during the presentation, we will follow up individually. Bob and Doug, thank you for joining me today.
Thanks for having us, Matt. Excited. And by the way, everyone listening, use and abuse that Q&A box. We love the questions. We'll make sure we get to them all.
Yeah. Yeah, we've been doing this for over 30, 35 years now, Matt, in the accounting industry. So there isn't much we haven't seen. Although with that said, there's a new surprise on the horizon. It seems like every day anymore. So
Wonderful. We appreciate your time and your experience here. So let's start things off with describing what is the current state of the CPA industry.
Doug, you want to handle that or you want me to take that?
You know what? I'll kick it off. That alone could probably be a 60-minute to 2-hour webinar question, but I think the best way that I could at least describe it or think about describing it is shockingly interesting. So Bob's been at this for 30 some odd years. I've been at it for a little over a decade, all in the accounting profession. And, when I started doing this, I thought this will be nice, stable, steady, predictable work. And then the past 5 to 6 years happened, and here we are. So I think it's a rare time where there's so much change happening at one time inside of a profession that everyone is figuring it out as we go. We're kind of building the plane as we fly. All of the merger and acquisition, outside capital, consolidation, paired with the advancements in technology, it's like a tinderbox. And now we have the kind of changing of the guard where we see a lot of the boomers exiting the profession, and that's like a match thrown right onto it. So I think it's a rare kind of unique situation we find ourselves in the accounting world, in the sense that all of these pieces are moving at the exact same time together, and everyone's kind of trying to figure it out as we go.
Yeah, my cut on that would be it's very transitory right now with a lot of escalating changes. As an example, if I look back just 3, 4 years ago, there was artificial intelligence as a line item in a conference. Now there's artificial intelligence conferences. Okay. And still, most people are still struggling to figure out how to implement AI. Many more private equity investors coming into the market, still coming into the market today after 4 or 5 years. The next level of flips or different kind of structures seem to be coming. There was an announcement that came out this week, and pricing changes are huge. The other thing I look at is misinformation. I am seeing so much misinformation and lack of information about how transactions work. When people start talking about multiples and deals, none of these deals are public, by the way. The only deal that's ever been public has been the CBIZ and Markham transaction because CBIZ was publicly traded. So any deal information you hear is always through some kind of a rumor mill. The other part of misinformation is the ability to implement AI. And right now, talking to some what we think are some pretty well-informed, educated AI professionals, even they think this is still an emerging market in its infancy stage. The last thing we're looking at is a lot of these firms are trying to figure out how to stay independent. No problem. If you want to stay independent, it's a good model. You can try and make it work, but you have to look at it beyond an emotional perspective and look at it as what's the reality? What's the data look like? Separate the data from the emotions. And then what's the independence plan? We have yet to talk to one firm who's actually created the independence plan who wants to remain independent, because I have to now compete with my $10 million firm against the other $10 million firm down the street that's now part of a $300 million company. And this is what's happening in the industry right now. It is, as Doug said, it's like a tinderbox literally going off right now. Matt, what do you think?
A lot of great information about what's going on right now and how it's changing, how there's a lot of action. What would you say is the biggest shift you've each seen in the last 12 months or so from what it was like even a year ago?
I'll kick this one off and let Doug close it. massive amount of intensified artificial intelligence conversation events, strategy focus, proposals going out. By the way, we do not provide artificial intelligence support. So if somebody were to come and look, does Visionary help us with our artificial intelligence solution? The answer to that is no. We're the wrong people to purchase that from, unless you want to just give us money for free, which is fine. But we'll be able to help you at least identify some people to talk to. The other thing I bring up is the boomerang effect, which is actually something that Doug coined on about 6 months back. We're now all of a sudden seeing everybody coming back going, maybe I made a mistake by looking at private equity, thinking it was going to just be a flash in the pan and go away. So we've got a lot of large firms, mid-sized firms coming back to us now going, we need to revisit this whole process. I think we may have made a mistake in our initial thoughts. I'm seeing more creativity in deals. I think Doug is as well too. So groups that are going out there coming with different ways to kind of approach this. One of my biggest shift I've seen over the last 12 months is layoffs. Uh-oh. We've got groups like Intuit, H&R Block, KPMG. All of a sudden, people are letting people go. Why are they letting people go? I know a lot of it is because of AI and the influence or anticipated impact of AI, but the layoffs to me are an interesting change and sign of direction, maybe what's going on out there. Like any crazy thoughts you want to add to this one?
I mean, I think if we look at, the last 12 months specifically, there's been an uptick in smaller transaction sizes. So everyone hears about all the consolidation, outside capital, private equity coming to the accounting world, all these different roll-ups. The focal point has been on mid and large sized firms over the past couple of years because those are the first targets to go down. So we're seeing a lot of renewed emphasis on kind of these downstream tuck-in type of transactions. So it's not uncommon for us to see a million to $5 million firm contacted directly by a private equity buyer out there. It's happening quite a bit. So I think the downstream emphasis on transaction sizes is a big shift we've seen in the last 12 months that will likely continue to intensify as we move forward here throughout the rest of 2026, moving into 2027. I say the other piece that in the last 12 months, this, I don't know how to put this nicely, there's been a sudden influx of experts who are entering the accounting profession, offering their technology workflow, artificial intelligence tools. Who 3 weeks ago were selling shoes at the mall or whatever, and that combined with a lot of people who are trying to break into the I'll call it the advisory space for the M&A world inside the accounting profession is interesting too. We're seeing a lot of people that we've seen around the profession work various jobs, functions, and all this fun stuff suddenly becoming experts in something that they have zero experience or track record in and trying to offer that to firms. So it's getting, I think, a little more difficult to kind of weed out the bad players out there who are just trying to ride, some of these industry trends in the accounting profession because it's so hot right now.
Interesting, Doug, on that same point. I just read something on LinkedIn yesterday. There were like 44 comments on it. It was exactly that point about how come everybody's become an expert in certain areas right now that they weren't experts in before. And there were a lot of comments on it. And by the way, they're not all bad players either. It's just people trying to figure out how to reinvent maybe what they currently were doing and put it into what is a new hot market. And we see this all the time in the M&A. We see people flash pan in and out who like so we've been doing M&A for accounting for 20 plus years. And they don't understand it's more than just introducing a firm. Introducing a firm's the easy part. The hard part's figuring out how to structure the deal, what the firms are worth, how to bring them to market, who to bring them to market to, and then working the whole deal through. And it's not always that simple.
I think that's a really great overview with some surprises, maybe some expected things as well. And you alluded a little bit to the private equity game getting into the smaller space. So let's switch gears more into the meat of what we're talking about, which is preparing for retirement or transition. So a firm could look at that internal option or potentially an external equity sale. When a firm's looking at their succession or independence versus being acquired by, say, a private equity group or a firm that's accepted outside capital, what should they be considering in their decision?
Hmm. That's a loaded question, Matt. That's that's a loaded question. I think a lot of it really starts with being almost almost I don't want to say hurtful, but being very honest on the
Yeah.
internal looking at internally on the firm here, right? Being open and honest, because that's not an easy conversation for a lot of partner groups to have out there, but it's something that's often overlooked. I think a big part of this is really removing the emotional side, from the business side when you're looking at this decision, because every single firm out there starts with the intention of, I want to remain independent. I want to pull off that internal succession plan, not realizing that, that's more than just saying that at face value. There's a lot of mechanisms and components that go into it and a very long timeline that go into it. So I think it's being as open and honest as possible to actually start that dialogue with your partner group to realize what is that best path forward for us as an organization.
So the things I'd like to add to that is, first of all, are they also comfortable selling internally for less than externally? They'd have to get comfortable if the market changes in values have occurred. It is what it is. So if my $10 million firm sells for $10 million internally versus 15 or $20 million externally, you have to be aware of that. Second, do they have a succession team with proven sales skills? So what we often see a lot is, I've got 4 partners in a firm or 3 partners in a firm, 1 or 2 are rainmakers, bringing most of the work. They're getting ready to leave. There's a next group below that has they're really good workers, are great at what they do, but they haven't ever brought in any work. So when the rainmakers leave, somebody's going to backfill that, and that takes a while to develop those selling skills. And I don't want to say that you can't gain value out of doing this, but you're not going to learn your selling skills by going to a boot camp for 4 weeks or going to a 3-day boot camp on selling skills. It just doesn't work. Um, is there a succession plan that the succession team is aware of? We see this a lot. The firm will say, we have a great succession plan in place. Have you talked to the team members about it? Well, they all want to be, they all want to go to the next level. But did you lay out how much the costs are, what the responsibilities are, what the skills are? Often that isn't clear. The other part, and Matt, you're going to like this part because I think this is the area where you guys get involved, is the financing clear? How are they going to be able to structure the buyout transaction? Do they have to borrow cash to make this work? What, I think one of the things you may do, by the way, this is not plug Broke Street. One of the things I think you do is also do some partner funding, like buyouts of the partner fund. So like, how do you get these pieces in place and clearly understood? So those are holes we see often in when firms are trying to get ready to go to market. Unfortunately, we do see a lot of these firms get stuck. They waited too long. We like to call it, they ran out of runway and they're forced to transact because they couldn't get the pieces together quick enough.
A piece too on this, we're big proponents of firms remaining independent here. We do a lot of, M&A consulting and activity and all that fun stuff across the industry, but a big portion of our business is working with firms to remain independent. Now, that doesn't always end up being the outcome of the engagement. Usually some people will come to their own conclusions that realize we can't quite pull this off, but a big piece of kind of making that decision on the front end too, I think is a little overlooked, is defining what independence really means for your organization. Because there's a lot of
Yeah.
creative takes on independence these days. Are you an actual owner in the business, or did you sell the business and now I have the facade of I'm independent because I kept the branding or but I don't make any decisions moving forward. So I think really defining what independence looks like, and it's not to say that one path is right or wrong. It's just understanding: do you truly want to be independent and stand on your own, or do you want more of the, I'll call, public facing facade that I'm independent? Again, neither one is right or wrong, but there are a lot of different options. It's a spectrum of options out there right now for firms who are exploring the options.
And also being honest to your own staff. One of the things about being independent is they want to still be able to control and exercise and run the whole thing, right? The reality is, if does remaining independent provide the resources needed for that staff to grow to whatever their next level of career is going to be? Because I've had firms come where the staff says, look, there's really no progression here. I'm doing the same thing I was doing 5 years ago. And I've got peers that are now involved in different levels of skills, and my skill set is going to become obsolete. Are you putting themselves in a situation where they can get those kind of resources, that they have access to the growth that they need? Because 10 years from now, I guarantee you what accountants are doing today will be completely different in the next 10 years. There's no question about that. Just not 100% sure what that's going to be, but it'll be completely different.
A lot of great points covered and what to consider and how many factors really come into play. So let's focus more on when right now. When's that right time for an owner to start preparing on his or her succession or equity sale?
Well, another semi-loaded question, Matt. Okay, so First of all, they should be preparing to sell the minute they open their doors. You should always be building the value of the firm to get ready to sell it. But if you look at preparing, and there's also a commitment. So let's assume that Doug and I have a firm. We have ABC Accounting, and we want to exit this firm in 5 years. Okay. There's a 5-year minimum, typically, transition period when you do a normal acquisition. If you're selling a firm outright, it's pretty quick. You're out in like 3 months. But when you do a normal acquisition in this market, private equity group or investor groups can be looking at, or anybody going to merge into, which are even harder to pull off anymore. They're going to look for a 3, 4, 5-year commitment. So preparing to get ready, you still have to add that 3 or 4 or 5 years on the back end. That's probably the best way I can answer that. Doug, any way to refine that line?
I'll do my best to refine that since it was a little all over the place, which is fine. I think
Yes.
when you look at timeline for preparation, it really is day one, like Bob alluded to. It's when you open the doors, because every single firm, every owner can often forget you're going to transact one day. It's going to happen. It's inevitable. Now, you're either going to do that internally to pull off a succession, right? You're going to do it externally, take on capital, sell to somebody, roll into somebody, whatever that looks like, or you're going to close the doors. Those are all options, and those are all of the options. That's it. And a lot of people don't necessarily realize that until it can be a little bit too late in the game. So, in terms of when to start preparing for that exit, it should be day one. You should be always negotiating from a position of power. Someone knocks on the door and wants to talk about investment into your firm, rolling into them, acquiring you, whatever the transaction structure actually looks like. You should always be at the point where you're commanding top dollar and never having to transact. That's when we see the values of firms start to fluctuate a little bit downward, is when they're forced into transacting because they don't have any other options. And a lot of these smaller mid-sized firms out there end up closing their doors. They have built an asset that is unsaleable. And that's not a fun or popular thing to talk about, but it is a real reality of what's happening right now in a lot of accounting firms across the country.
Good points there. Now, this next topic, we've covered a little bit why internal succession is becoming harder to execute, but how's that impacting the firm owner's decisions whenever that is becoming difficult to execute?
All right. So think of it, there's been a gap in the pipeline here for, only define the pipeline of incoming professionals in the accounting area for a good 15 to 20 years. The gap has gotten really wide, and we've got what's really kind of an hourglass figure now. So we've got leadership at the top, thinner middle, wider base, because we have more people in theory coming into the profession. Hourglass is a problem. I don't have enough managers or directors that want to buy the firm out. Second thing is there's been a change in culture, which really was triggered a lot by COVID. When COVID came, it forced a lot of people into into remote working situations. A lot of people didn't want to come back from that. They like the lifestyle, the cultural change, whatever. And that has become a permanent factor now inside firms where people are wanting to embrace I'll participate but not want to own desire in how they want to live their lifestyle. They also let the challenges and investments to make in AI, just because a firm does an internal succession, those challenges don't go away. So the succession team needs to figure out how to put AI and advisory and all these other changes into place. And they're concerned that the labor pool is going to be thinner. I kind of view AI, by the way, as a way to solve some of the labor pool issues, the gap, but that's a conversation for a different day. And then back to that internal buyout value versus external buyout value gap. You got to get comfortable with it and measure how big that gap is and roll from there. Doug, your thoughts?
It's becoming more difficult to execute, on the internal succession. All those pieces make a lot of sense. The accounting profession was built as a pyramid scheme, a really successful, strong, ongoing pyramid scheme. And, pyramid's only strong as those blocks on the bottom. And with all of these kind of cracks happening across the profession, it's becoming more difficult to really pull off that internal succession and truly remain independent. So I think a lot of firm owners are looking at this decision not from a selfish standpoint, but just from a business decision. It comes back to
Yeah.
what I said earlier, is removing the emotional component from this and just purely looking at your situation, understanding the numbers, understanding your timeline, understanding the mechanisms and the options that exist in the market. I mean, that's a very difficult thing for a lot of people to do. And like Bob alluded to, for whatever reason, This is not a blanket statement on young professionals. There's a lot of strong upcoming young professionals in the accounting world, but the desire to actually own and operate and run the firm, from a shareholder perspective, is becoming less and less commonplace in a lot of firms. And that creates a lot of opportunity for those who are entrepreneurial and want to break off, start their own firm, or rise through the ranks to that partner level. But there is that decrease in the willingness or desire to move into that role. And I think a lot of that is honestly due to such a talent shortage that, when you start moving up the pay scale inside a firm, you can have a very comfortable living without having to own and operate and buy into that firm. So we're kind of at this weird little crossroads right now. And I want to be very clear, ton of great, phenomenal young talent uh, out there. It's not to
Yeah.
say that we're all gloom and doom, but just as a rule of thumb, there are more and more younger professionals who are kind of straying away from that traditional partnership ownership path and doing it intentionally.
So if and Matt, to throw something in on top of that, like if you look at the Silicon Valley out in California, they've been struggling with this problem for years, where all the accountants get sucked into these high tech companies because the accountants are going in and getting stock options in these companies, getting more potential for high end cash. And what has changed culturally is what Doug alluded to before. The pyramid scheme was I work for my 30 years or 40 years in the firm. I become a partner. I become an equity partner. I get my deferred comp on the back end. A lot of the younger professionals want more money now. They're interested in the equity stock option that's emerged, just like what's always happened in the Silicon Valley. And some of that stuff bombs out and doesn't work out. But that is one of the big drivers, I think, also creating a lot of this change is the desire for more capital and cash earlier in your career than waiting till you're in your 60s to get deferred comp payout over 10 years. And that model's become very difficult for firms to get their hands around anymore because they're also unfunded buyouts. I know about 5 to maybe 10% of the firms have completely funded deferred comp buyouts. The rest are all going to be funded by whoever buys that firm internally or externally.
Yeah, so a lot of this focuses from the current owner perspective, potentially selling or having some level of succession, coming with really good pre work. So let's talk a little bit about your experience and leverage your knowledge with some pre work here. What could be coming for alternative sources of or what could be coming for alternative sources of financial structures for those accounting firms?
Do you want to hit this first or
Why don't you can make a mess again? I'll clean it up.
I'll make the mess?
Yeah.
Okay. I do believe that the alternative financial structure coming in, well, first of all, these firms that have taken capital already, are now restructuring and getting another buyer, and that's actually starting to happen now. Um, but I believe the minority interest is what the big interest is going to be. I if I'm a $10 million firm and I want to sell 30% of my ownership, say that $10 million firm's got a market value of $15 million. So right now, nobody wants to give 30% of $15 million, which would be about $4.5 million as an investment. I think that's going to change. The minimum investment's been about 25 million right now. So for me to do a $25 million investment into a firm to like 30%, it's going to be a 50, 60, $70 million firm. I think that's going to be a huge change in the market. And there's going to be some people that are going to want to do that funding that's going to be really successful. The question is, what's the call period? Meaning, so Matt, so you give me $4.5 million for my $10 million firm valued at $15 million. All right. How quickly are you going to want to call those terms back? Would I have to pay you back after you could call back after 4 years or 30% ownership and then I have to sell or refinance? There's going to be a lot of that going on, but that's where I think the biggest alternative source of financial is going to come from. The other is creating your own internal capital, which is a session for an entire other day, but that's changing how you price and how you do your capacity burning and the rest into your client base. Doug, thoughts on alternative financing?
So it might be kind of an indirect answer to your question there, Matt, but I think in what I'm actually seeing now is there's going to be more of these peer-to-peer run kind of networks of firms that are created to essentially pool financial resources to be able to invest in technology, share best practices while still owning and operating your own firm. There are some that are doing this phenomenally and have successful networks of firms. Others are slapping it together, with duct tape and trying to figure it out and likely won't be here this time next year. But, that thought process of banding together, as a small or mid-sized group of firms and trying to figure this out as opposed to taking on outside capital, selling, doing whatever. I'm not saying it's right or wrong. Some will be successful, others will likely struggle pretty significantly. But I think that thought we're going to see more of those type of peer to peer groups really form over the next 6 to 12 months here to try and combat all this change that's happening at one time here.
Yeah, it's very interesting marketplace right now.
Doug, we see the same thing here too. Structures continue to get more and more creative, and there are a lot of different changes that we're seeing that may not have existed a few years ago and are becoming much more popular now. So we see that on our side too. So interesting to hear from that side.
And Matt, you're deeper on the actual financial structure side of things than we are. But creative doesn't always necessarily mean good, if I'm not mistaken.
That's absolutely true.
We're seeing creative things all over the place right now in the accounting profession.
Well, sometimes you're baking more risk into a creative solution. Like I'm gonna bank, I'm gonna be able to grow. And part of our deal structure, Matt, is you finance a deal based on my growth, and the clawbacks could be I don't hit the growth. We're both gambling a little bit on that if that happens. But I think there'll be more of that, and I do believe there'll be more focus on really generating internal capital. And I don't mean that not getting financing. I'm talking about just how I look and examine it every single client, as well as every single professional in the firm on how they're performing and how they're charging, and the decisions they make. We see a lot of firms write down and write off work, a ton of work, before it ever gets even to the billing stage. I think that's an opportunity right there for firms to be able to create some capital to be able to make investments. But that's a different and longer conversation.
Now, Bob, you had brushed over a little hypothetical situation with purchase price and a market value. What are we seeing with prices in today's market? What multiples, what earnouts have you seen lately?
Okay, so I want to back the question up a little bit. The mistake everybody makes in this conversation is talking about just the multiple. The multiple is what I'm willing to pay, Matt, versus what you're willing to pay and versus what Doug's willing to pay. What firms need to get their head around is how do you get to the net adjusted EBITDA? That is the key to the equation, because that's the first part where the multiples layer it onto. So if my net adjusted EBITDA is $2 million and my multiple is 6, my price is going to be a $12 million transaction. I may be willing to pay you a 6, Matt. Doug may be willing to pay you an 8. But if we get the net adjusted EBITDA on a level playing field, that's the key to this. We see multiples anywhere from typically, I will say, Doug, 6 to 11 right now. I know a lot of people are flipping 12s out and hearing where it's 12, 12, 12, 13, 14. The only way people are seeing a number like that is if they've actually received a number like that, because nobody ever talks about their deal terms and structures. So there's a lot of rumor on that. The other part, Matt, if I'm going to give you a multiple like 14, let's get up there. Let's get that multiple way up there. What's that net adjusted EBITDA I'm basing the multiple of 14 on? It could be a low number. I could give you a 20 on a low net adjusted EBITDA number, and it sounds great. But you can walk around going, I got a 20. I got a multiple of 20. But your purchase price is really what counts. And then the deal terms that surround the whole thing out. On your earnouts, all dependent on risk. So most earnouts are very reasonable with a certain percentage of growth, typically revenue, and a combined with some kind of a EBITDA version of growth of that. But there are other things, like some firms are building earnouts with projections into them. So I'm going to be 20% larger next year. If you're going to say that, that's going to go into the earnout is a risk. So you have a higher, steeper earnout. I've got a lot of large clients. So if I have a lot of large clients, it could be potential loss that could go into your earnout risk. Or I've got early exiting partners, another factor, because I may not be able to transition my client base over quick enough. So the risk may go into earnouts. Most firms set earnouts that are reasonable because they don't want the person being acquired to fail. They want them to achieve and actually overachieve. So Doug, your thoughts on all that wonderfulness?
A lot of wonderfulness there to digest. But, I think kind of to echo, because I want to be really clear, there's no public database that says here's what firms are selling for out there. So we see a lot of people who write articles, do podcasts or say at conferences, say this is what all firms are selling for. There is no public information on a lot of this. Matt, just for fun, we're kind of doing some analysis in the back end here. I'm doing this live, so it's a little bit rough, but I looked at the last 30 letters of intent we received. Firms all sizes, all over the place. Last 30, just to give a nice recent example of some deal structures. Average multiple on adjusted EBITDA was 7.3. The median was 6.6. Now, of the last 30, there were 7 of those that came in at double-digit multiples. So there's no one size fits all, and I'm not saying that's where all firms should be. Generally, when we see firms get into the double-digit multiple conversation realm, it's the larger firms out there. It's just the nature of the beast. So if you're a small mid-sized firm, and you hear, "Oh, firms are trading for 10, 11, 12, whatever," maybe take it with a really big grain of salt. That's kind of the point to get around there. No 2 deals are the same. Hundreds of deals we've seen over the years. I don't think I've seen one that's been the exact same structure from anything else. So
Right.
even with the same buyers, we worked with a lot of the same buyers for a very long time here who've done, 10, 20, 50 transactions over the years. No 2 deals should ever really look the exact same.
Yeah.
I think there are a lot of great points made there.
There's a lot of raw data we're looking at too. We're looking at like net adjusted EBITDA as a percentage of actual gross revenue, like where they came back to that number determines how that can impact the sale, the purchase price, and then the multiple. So we're looking through all this data we have going, how do you answer that question to a firm? Really, all it comes back down to, Matt, is how much I'm really interested in your firm. Like, if I put you in a small location, I may not be quite as interested as opposed to sitting you in the middle of a large metropolitan area. And if your firm's larger or has a niche, there's so many variables to it, your bench, a lot of things to it.
Great. So let's get back into a little bit of that timing. Now we know succession plans should start right away, but what are those looming signs that it might be the right time for a firm to consider selling or bringing on an additional partner?
Doug, would you prefer to go first or?
Well, I think the obvious ones is an aging ownership group. That's just nature of the beast right there. Aging ownership group, that should be a regular conversation to make sure that you're in a good position if and when you do need to transact. That's kind of one piece. I think another piece that can be overlooked is look at the past 5 years of growth. Have you hit a flat plateau on growth over the past couple of years? Is your growth percentage slowing down significantly? Whether that's due to workflow, staffing, turnover, recruiting issues, whatever it might be, are you hitting a growth plateau where you're at? Because I think it's not uncommon for us to hear firms go, we've taken our firm to this level, but we're not the people to take it to the next level, and understanding that and just being open and honest, with those pieces. But the biggest piece is that aging partner group just hanging on a little bit too long, in my opinion.
Yeah, and some of the other signs I kind of see is the Doug coins, the inability to grow up and kind of flatlining. I've been, $8 million in ballpark, maybe within $500,000 over the last 4 or 5 years, up or down. Rainmakers exiting soon. That's a big sign in my book of things to look for. Lack of advisory services. I can't sell anything other than my tax compliance or my audit or my accounting. I can't get that penetration open. The other part too is a big sign we look at is equity partners billable hours are increasing or high. That means I've got leverage issues. And the reason I've got leverage issues is not because equity partners love to do more billable hours. It's because they got nowhere to push it down to. And once that happens, firms start to bottleneck and cap. And when they'll cap because I just don't have time to go out in the market and bring in new work, which is what I should be best at a certain stage in my career, and not doing a tax return, but having the people beneath me do a tax return, let me manage it, let me train them. Those are huge signs we see in the market to bring in another partner. And the question is, what kind of a partner? So we see firms actually going, let's define a partner. Like I'm going to bring in another individual, or I'm actually going to go and get, do a transaction in the open market to get an equity partner of some shape or form. That's an interesting one. And Matt, to throw out the concept that's really not on your list right now probably is mergers. Like when I got a $10 million firm, I'm going to go into a $30 million firm. We don't see a lot of that happening um, at this time. Sorry about that. That connection got a little unstable here for some reason. We there? All right, Doug, why don't you take the rest of this question over because apparently my connection is weak for some reason.
Sure. I'll just have to infer where you were trying to go with that one. It's pretty rare when we see a pure merger anymore. I mean, that was the industry standard for a long time. no cash. I'll roll into the existing deferred comp of the larger, or if they're two equals, we'll figure out and put all of our chips in one pool. They're still happening, but to be honest with you, they're far and few between these days to really come by. So, when we look at transactions, the pure merger with no cash, no earnout, no change of ownership, it's pretty rare when we see those type of transactions anymore. And usually when we do see them, Matt, they're at the very small firm level.
Makes sense there. And we went through a few different metrics there really that they should be paying attention to. Are they plateauing? Are they getting into that situation where they're an aging group? Are there any other metrics that a firm in general should be paying close attention to? Maybe they're already pursuing that sale, or they're already know that they're at that point that they're moving for a sale pretty soon.
Absolutely. There's hundreds and hundreds of like we can get into like baseball statistic type of things, right? We don't need to do that for firms. We look at some of the core, the large, the overarching pieces that are involved in most transactions, really the revenue per head inside a firm. That's a big one. There's a couple different ways to cut and calculate that, but understanding exactly how much revenue you have per professional inside the organization, that's kind of the baseline heartbeat metric that a lot of acquirers really look at from the get-go. That along with the revenue per equity owner. That's a big piece there, which ties into one of the earlier comments about like billable hours at the partnership level. Revenue per equity owner inside the firm is a big tell of how that firm operates, what their leverage situation really looks like, and ultimately how profitable they're going to be on the bottom line. Realization percentage, obviously it's huge, but we look at realized dollar per hour is one of the more, I'll call it true metrics. When we look at realization issues inside of a firm, you can get into AR whip, write downs, write ups, all that stuff. What are you billing? What are you collecting? Those are two different numbers of just about every single firm we see out there, Matt. And a lot of people don't represent their firm in that light. We're seeing a lot of good sized firms starting to explore the market here, Matt, that they're writing down millions and millions of dollars off their gross revenue. And that raises some questions as to how they got there. And a lot of these other pieces go into it. But to answer the basic one, listen, revenue per head, revenue per equity owner, realized dollar per hour, those are kind of the three core pieces we look at with pretty much every firm out there.
Hey, Matt, I just want to kind of throw in, I think I'm still here, but for some reason, the visual seems to be off. Can you hear me properly?
We can hear you loud and clearly.
Yeah, you actually look better this way, frozen. So that's perfect.
Not exactly sure what's going on here because we're literally sitting next to each other in different offices, but okay. The other part too, when Doug had mentioned it, we're seeing a big thing with like swings and like AR and WIP balances. So, when you look at metrics that we think firms should be looking at, first thing we ask to know is are they accrual or cash basis? Because when they're accrual, they may have a backlog of their AR impacting what their partner compensation is and percentage of what appears to be, what they're getting paid for compensation really can impact how the firm looks like it's operating from a profitability perspective. So if they have big swings in their AR and WIP, they may have a lean year followed by a really overly profitable looking year when they normalize it, it makes a huge amount of sense. And to Doug's point, the amount of write downs are huge in a lot of these firms. And to me, that's a growth opportunity. So, alrighty.
Great. Let's get into growth tactics really quickly. What growth tactics should firm leaders be looking at?
So this, I'll kind of give you the overarching leadership ability. I think that's the biggest one out there. Being honest about the leadership ability inside the current firm today, because that trickles down to every other piece. That makes up the growth strategy for a firm. Pricing, this is a dead horse. I'm going to continue to beat over and over and over. Any pricing, fee structure issues that are starting to come out in the market, those are really only at the big four level still. So if you're a small, mid-size, even a top 300 firm, continue to upscale the pricing structure, upscale the fee structure. Client capacity remains a big issue inside so many firms as well. Everyone's number one complaint is we don't have time to take on new clients. We're at capacity. We can't do this, that, or the other. I can't recruit more. Why are you working on clients that are not good for the firm? Low fee, high volume clients. The 80-20 rule, if you're not familiar, Matt, is alive and well in the accounting profession. 80% of the organization's revenue is coming from roughly 20% of the client base. We actually see a lot of more like 90-10 rules out there, Matt, to be honest with you. So why are you burning all of this valuable capacity on this, low fee, high volume type of client? You know, and it's really easy to talk about this stuff, but it, it's very difficult to look at your firm from just an agnostic perspective and go, we're not doing this the right way. But it always starts with who you have as clients and what the fee structure is inside the base. And it should be reviewed quarterly. And you should be just not shedding, but upscaling the client base as you continue to move forward here.
Yeah. On the pricing, to add on to that, one of the biggest issues we see is it's easy for me to write down the value of the engagement because I'm afraid you won't pay the bill, Matt. So I write it down before I even send you the bill. The reason I do that is one, I may not have confidence in what I'm doing, and it's possible I could have screwed something up that it's on me. But the bigger thing is my lack of selling skills. I don't want to have a conversation with you that says, Matt, we need to charge you more because of these factors. So if I have weak selling skills, it flows right through my entire client base on how I charge. Doug's point about the client capacity, one of the things that we do here is this model we've put in place. It's an engagement we do with firms. We one of the key things in is a client mapping. So we actually dot out, red graphically display all of their clients in green, yellow, red, and black dots by realization. It's amazing the red, and you don't want any red. You don't want any red or black on your mapping, but they're there. And when you start to look at them, it becomes for some firms just an overwhelming number. The last two things on this is partner alignment and partner accountability. I need all the partners to at least agree on the vision. So, Matt, if there's a three of us and three more partners, or six of us, but you violently disagree with what the other five have agreed to think the direction of the firm is, that's okay. We just need to make sure you're in agreement with what we're going to do, even though you don't think it's the right direction. The other part is accountability. So if I'm sitting there writing down 30% of my book, and Matt, you're value pricing and getting like 120% realization, you're paying that same price for me writing that information down, those dollars down, and so's my team. I don't have money to invest in staff, to buy resources, to bonus out staff. I need that. That to me, the pricing, the capacity issues, the alignment, and accountability, four big, four big issues to look at inside firms.
Great. So outside of this client mix or outside of um, these specific types of clients, of course, it's going more to the 90-10 rule. We've been seeing that in a lot of different industries as well. How can clients then continue to grow while planning for a future transition? Or
Well,
how can firms continue to grow, I should say?
yeah, well, I figured that was where you were going with that. So we got it'd be interesting if clients were telling the firms how to grow. I think increasing the leverage, that's a big component here. Bob alluded to it earlier. When we see high billable hours at the partner level, that's a bit of a red flag with how the firm actually operates. The most successful, the highest profitable, highest partner comp firms we do see out there, whether they've taken capital or independent or whatever, they have really low billable hours at the partner level because they push that work down. And it sounds simple, it sounds easy to do. Honestly, the highest performing firms we see is where they have the managing partner or the highest partners in the firm, highest owners inside the firm, billing zero,
It's pretty
zero
rare.
billable hours. It's rare, but those are always the highest performing firms we do see out there in the marketplace. So I think that's a big piece, Bob. I need your thoughts on how to grow for the future.
Okay, first of all, focus on what moves the needle. Here's a great example. Matt, $5,000 tax return at $500 an hour. Sounds like a great deal, right? How is a $10 million firm going to achieve the growth they need to achieve if $5,000 a crack? They need to be looking at how do we have 50, 100, $200,000 clients. Do they take the $5,000 client when it comes across? Yeah, but that shouldn't be the focal point. If they're not focusing on what moves the needle, they're going to miss their mark no matter what happens. Stop burning the capacity on underperforming clients, as we talked about before. That's to me is a really difficult conversation because they've been a client for 15 years. And we built the firm around, 15 years ago, we really needed this client and they're really good people. Go into a grocery store, go buy a gallon of milk, Matt, go to the counter and go, this milk is $5. I only want to pay $3 for it. See if they give you the milk. Okay, let's see if they make a deal with you at the grocery store on pricing. But for some reason, when we're selling professional services, it's easy for us to undervalue the value of that service or the quote unquote the product. The other part is leveraging and training. But the last thing I think is niche expansion. If you want to really make your firm grow, the most profitable firms we've seen out there have deep niches, often in real estate, which makes sense because, in partnership groups, highly well-funded people, but the niches make the big difference. And it doesn't have to be just a niche in an industry. It could be a niche in a service area, like you're blowing open the CAS area. And maybe you're focused only on private companies or private companies in a specific sector. Those are the areas that those firms are most impactful in the market. All right.
And again, if there are any questions that you have, please submit because we do have one final question left before we get to that potential area. And that is, if a firm feels stuck or unsure where to start, what are the first steps they should take to evaluate their options?
So maybe for just transparency, let's break it into two categories, Matt, if that's all right with you. Let's assume we're never going to talk to this firm and we just want to give them advice if we can help them in any way. So if you want to go at this trying to figure out, what options exist in the marketplace without our help, by all means do it. Sit down as a partner group, be as honest and realistic as you possibly can about what you currently have and how much time you have to make a decision moving forward, whether you're going to do that internal, external, or to shut the doors one day. Be honest, open, and understand exactly what your timeline is. More importantly, understand what you do and don't do well inside the firm. Because if you explore these external options with, a potential sale or transaction or whatever it looks like, understanding exactly how to present your firm to prospective partners out there in the market is a big piece that goes on behind the scenes a lot of people overlook. It's not just always the numbers. You have to understand the story and the why behind the numbers exist the way they are today. Plus, being able to say, if we make these changes, here's what's going to happen for the firm moving forward. And understanding that story is a big part, the puzzle that a lot of firms often overlook when they attempt to explore the options in the open market. That and I'll kinda echo what Bob, mentioned a couple moments ago. Focus on what moves the needle inside the firm. Don't get caught up in trying to optimize your workflow so much in this, that, or the other and implement all these technology solutions if it's not moving the needle on growth. That's the biggest, I think, takeaway that firms can do on their own without any support from a group like ours or anything like that. And I'll turn it over to you, Bob. What can they do with us?
I'm going to hammer on that optimizing the workflow. Okay. And you should optimize the workflow. And eventually, if you can get the systems so that the tax return is automated and nobody ever touches it, a human being never touches it, other than maybe to communicate it to the client, that's great. The problem is there's only so much you can squeeze out of the workflow. The problem isn't the workflow, although it's a factor. The problem is we're not charging enough for the work. Okay. So, if I've got a $10,000 return and I'm trying to figure out how to get the margins to X, it's a lot easier if that return was $15,000 because I'm going to have the same cost structure into it. And that's where firms need to start looking at hard. Um, the other thing too is, I think that you maybe talked about this, but let me just restate this. If not, group needs to sit down. The partner group needs to sit down and have an honest conversation about what's working and what's not working. Okay, what's work, and it can't be like, oh, I'm making a good income, and I don't want to make changes. By the way, we see that, Matt, as a big problem in succession. Okay, I want to make $500,000 a year. I'm making $500,000 a year. I want to make that for the next 5 years because I've already done my calculations on what I need to retire. I don't want any changes. I don't want to make any investments. I don't want the environment to change. The problem with that is when you run into that flatlining, that's when you start to lose staff because they don't see any change or upside or vision. And when you start to lose staff, that's when the partners start to have to get more involved and they complain they can't find enough staff. But uh, that's where I would go is get an open dialogue with your firm and really put it all out there. And it may not be comfortable. It probably won't be comfortable, to be honest with you. Um, there's a question that came in here, Matt, though. I'm going to answer that.
Absolutely.
Is there a difference in where a firm is located? So does that impact how they look at succession or look at a transaction? And the answer to that is 100%. So for whatever reason why, different markets in the country have hotspots. Some are permanent. Houston, Dallas, Atlanta, Boston, hotspots forever. Nashville, off the charts hotspot right now. Don't understand why. Austin, Texas wasn't off the chart spot. It's still a nice place to be, but it's not like where everyone wants to have a firm at this point now. But the markets do move. And the problem is if I'm in a secondary or a third level city, and I don't mean disrespect to a smaller community, often those markets have limited potential buyers because they're servicing a community, and the smaller the community is, the tighter knit it is, the harder it is to make change. If there's only one grocery store in town, or they all go to the golf course on the weekends for dinner and country club kind of stuff, and it's the only place in town to go, it becomes a lot harder to make effective change and grow a firm. So geography does make a difference for a lot of these firms.
I think a point on geography too. There are premiums and discounts associated with different geographies, kind of like you alluded to there. However, if you're in a geography that might be viewed as a discounted type of geography for whatever reason, whether it's size, where you are in the country, available market, whatever it might be, there are specialist groups out there who are now forming these large national entities by acquiring these firms in second and third tier type cities because that's the client base they serve well. And that's how they're implementing their technology solutions to support those bases. So it's really understanding it's a spectrum of potential transactions out there if and when you want to explore the market. Because just talking to a handful of the large acquirer names that we see thrown around all the time might not be the best route for you if there are specialists who are not discounting in certain areas or based on certain service lines or whatever your situation might be. So it's really understanding the whole picture and really looking at each individual option as it exists to your specific situation.
Wonderful. Bob and Doug, you've been full of a lot of great information throughout this webinar. So again, audience, if you have any final questions or answers for Bob and Doug, please submit them. We'll turn it over toward the closing though, and they could get back to you individually at that point in time. So I want to thank you both for being here today, sharing your insights with our audience. Thank you to those who tuned in and submitted the questions there as well for both Bob and Doug. We appreciate your viewership. And again, thank you very much, Bob and Doug. Stay tuned for our upcoming webinars as well.
Thanks for having us, Matt. This was enjoyable. I'll tell you, I didn't expect much, but this was enjoyable. This was actually a fun one. I appreciate you having us on, Matt.
Thank you.